tariffs and the uncertainty of the economy right now is having an impact in a wide range of areas. But now private equity firms are being impacted. They are slowing down their activity around deal making while focusing on their current portfolios due to all the tariff activity. Pleasure to be joined right now by Burcu Esmer, who is a senior lecturer in finance and academic director of the Harris Family Alternative Investments Program here at the Wharton School. Burcu, great to talk to you again. How are you?
Very good, Dan. It's always a pleasure to talk to you.
Thank you. And so I guess for those people that don't follow this closely, talk a little bit about that connection between private equity and how they're being impacted as all of this conversation with tariffs is going on.
Sure. When tariffs go up, costs for a lot of companies rise, especially if they rely on imported goods or parts. That hits their earnings and makes it harder to predict future performance. The private equity firms, they really need stable earnings to value companies, plan the future, plan investments. When the environment gets this unpredictable, with trade policies shifting week to week, PE firms, they usually slow down because they don't want to buy into a situation where profits could suddenly fall because of new tariffs. And in general, in private markets, the sentiment is wait and see. Firms are being patient. Private equity tends to move carefully anyway, and right now, most groups are putting their pens down and waiting for things to settle. The big question is, how long can they afford to wait? So when we think about the impacts, we will talk about these, I'm sure, in the next couple of minutes, but there is the portfolio company management issue. There's the fundraising issue. Are they going to be able to get new investments? There's and then there's the exit issue. How are they going to exit? So there are multiple legs or processes we see in private equity that is being impacted by tariffs and the changes.
So let me ask you about the investment side for a second, because, the old line we talk about in and around the markets and Wall Street is that the markets love certainty. And obviously we are at a point right now where we're not seeing as much certainty. And so I would think for investors in private equity, they would have to be very concerned about what is going on right now and potentially PE firms stepping back.
Oh, that's exactly right. I talk to many people, LPs, capital providers, and GPs, and they're all trying to make sense of things. There's a chaos, there's a lot of noise. That's why they're in this wait and see stage. But some GPs are pointing to the long-term nature of private equity investing. So they basically say, oh, don't worry, we can buy by law when things are a bit crazy, the markets are a bit messy, and we can ride out economic cycles. Yes, that's right. There are a lot of opportunities across both equity and debt, because we know that when there's dislocation, we often see opportunities to create value if you're patient. When public markets are messy, private equity shines the best in general. But at the same time, firms are being very cautious. They're modeling their downside scenarios, they're stress testing potential investments, and they are running a lot of what-if analysis around trade risk and economic risk. They're also working closely with trade advisors and legal advisors to stay ahead of any policy changes. So when necessary, or if necessary, they can adjust their strategies very quickly.
So how are the firms then handling the portfolios that they already have and trying to work with them to keep them as strong as possible in this time of flux?
The biggest concern is how to deal with portfolio company earnings, especially PE-backed companies in manufacturing, industrials, consumer sectors. They're feeling the pressure from higher input costs. It could be raw materials, it could be components, but all of a sudden, let's say you're a PE-owned auto part manufacturer, now you're facing an increase, a 25% tariff on certain parts coming from China. You see the direct hit to your margins, right? It impacts the profit, it impacts your cost. So we see this more and more often. Some companies are trying to pass those to the customers, but this is, of course, a risk. This means that they're risking to lose market share. Others are choosing to absorb the cost, which cuts the profitability. So it is chaotic. Of course, there's the supply chain reconfiguration as well. This is something we started to talk about during the pandemic. And some companies shifted to their supply chains back to the US. These were the maybe lucky ones, but this is just a handful of firms, right? Relocating your supply chain, it's costly. And if you want to do it now because you're worried about tariffs, how it will impact your supply chain, then you need to take action. You need to rethink about your supplier networks. But those changes, they don't come easy. They come with delays, inefficiencies, extra renegotiation costs. Even when companies move to new international suppliers, like not moving to domestic, they can still face logistical hurdles and higher shipping costs. So what we are seeing is, again, downside scenarios, what can go wrong. They are reviewing the tariffs and the impact of tariffs, or the expectation of changes in tariffs is also priced in the input cost as well. So we see a lot of changes, and they're carefully reviewing their contracts into detail. They're trying to make the changes if necessary and if it is easy enough. And but the immediate thing they do is actually cutting costs. So they are very careful about the rest of their balance sheet and income statement. They ensure pricing strategies account for tariffs. They make sure that they don't get caught short on tariffed goods. So these are the immediate actions they do, and then considering relocating their supply chain network.
So I'll finish on this because the expectation is that no matter how this all plays out in the next several weeks, months, whatever that time period is, that there probably will be some level of tariff that will be included in it. Are private equity firms already kind of building in what they expect to be at least a minimal tariff in place longer term right now, because they need to think 6, 12, 18 months out at this point?
They started doing that, obviously, but what they want more than anything is clarity. Once tariffs stay in place, once the rules are clear and stable, they can model the risk, they can price them into their deals, and they can just move on. It is the constant change that is the bigger problem. Private equity firms, they are used to dealing with challenges, especially the buyout firms. They use a lot of leverage. They need to be ready to changes in the environment. And in general, I always say private equity is really all thinking about what can go wrong. This is their mindset anyway, but they need to know what the playing field looks like.
Burcu, great to have you with us today. Thank you very much for your time.
Thank you, Dan.
Thank you. Burcu Esmer, who is Senior Lecturer in Finance and Academic Director of the Harris Family Alternative Investments Program here at the Wharton School.